Hello, everybody. This is Jim Denholm, founder and CEO of Iron Bridge Private Wealth in Austin, Texas. This is the Strategic Growth Video Podcast, and today is November 19th, 2021. This is the Big Five. So the five topics we're going to talk about today kind of has a 70s theme. So we're going to start by looking at the market in the 70s. It's something we call return-free risk. We'll look at the best performing assets throughout the decade, talk about the largest five stocks in the S&P 500, how that compares to historical weightings, look at U.S. versus international stocks historically, and then also talk about the PE ratio, the price to earnings ratio of the S&P 500, and specifically how it relates to treasury yields over time. So let's get started. So our first chart, we're going to talk about the 70s. This is a chart of the S&P 500. Started in 1967 and went through kind of late 1982. And you can really see that from 1969 was this peak, kind of early 69, all the way out to sort of mid 82. Markets didn't do anything. The overall S&P 500 was flat for more than a decade. But there were major drawdowns. We had a 33% drawdown to start the decade, nice rally up, almost a 50% decline mid-decade. That took a couple of years to occur. Another pretty big rally, an 18% drop, another big rally to new highs, and had another 26% drop. So this 18% isn't too major, but 3 to 4 pretty major bouts of volatility throughout the 70s. This was a period where we saw rising inflation, rising interest rates. We're about to go into that kind of a phase. So I think it makes sense for us to go back and look at what happened in the 70s, and it frankly isn't very good for the large U.S. stocks. What was it good for? This looks at different asset class returns throughout the 70s in gold and commodities. As you would expect in an inflationary environment, gold and commodities did very, very well. This is annualized return. So per year return, gold returned almost 31% per year. Commodities almost 24% per year. S&P 500 out here on the right only was up 1.6%. That was from December 31st of 69 through December 31st of 79. But as we saw in the chart before, we kind of extend that out a little bit. The returns were zero annualized. So what does this tell us? It tells us a few things. One, we're not quite in this environment yet, but it sure does look like we're approaching it. It looks like there are inflationary pressures. Interest rates have started to gradually move higher. Whether we're going to start this kind of choppy flat market just yet, I'm not sure. We may have a little bit more time of good S&P performance before we get into this period of choppiness, but we definitely need to be watching out for it. Some of the interesting things that we saw, one, small cap did better than large cap. It's not on here. International did better than U.S. large cap. Bonds did fairly well. This was surprising to us, but a lot of this was backloaded in the decade. As interest rates went up, various bonds were paying 8, 10, 12, 14% per year. And the price volatility started to fade. So you got kind of back end of the decade when you did have really nice high yields on bonds, you were able to get a period of fairly good returns. Value outperformed growth. Market never necessarily repeats itself, but it does oftentimes rhyme. And we need to keep this in mind that we don't need to be super focused on the S&P 500 if we start to go into an inflationary environment. So looking at the S&P 500, this is another thing that's kind of interesting where it looks back at the 70s. This looks at the weighting of the 5 largest stocks in the index. Right now, they're Microsoft, Apple, Amazon, Google, and Tesla. And right now, those 5 stocks are 25% of the weighting in the S&P 500. The S&P 500 is 500 stocks, and the top 5 are 25% of the weightings. This just means that the overall index is kind of dependent on what those top 5 stocks are doing. If those are doing well, like they have this year, I mean, Tesla's up 150%, something like that, so far this year, that contributes a lot to S&P 500 returns. We're now sitting at all-time highs in the S&P 500, but 85% of the stocks in the S&P 500 are not at all-time highs. It's this narrowing of concentration in the index. And it's interesting that the last time it was up here around 25% was 1970, right as we started to get into this inflationary and rising interest rate environment. Another interesting thing to look at is just as recently as 2016, these top 5, and they were not these same top 5 stocks, but the top 5 stocks that year were only a little over 11% of the index, and now we're sitting at almost 25%. So something to watch, and that's why it's these, we talk about the FANGs and talk about some of these tech stocks. They're driving the index right now. And it's good while it lasts. If they start to underperform, we should expect a drag on S&P 500 performance. One of the places that might benefit if the S&P 500 does start to weaken or does go through a longer period of kind of choppiness without a lot of price movement upwards is international stocks. So, international stocks, having that in your allocation over the last 10 or 11 years has basically hurt performance. We're very tactical, so right now we have very little international exposure. We've gone through fairly long periods with zero international exposure, but we think that could change, and we could have 20 or 30% international exposure for our more aggressive clients if this starts to flip. And it's been very cyclical. So if we look, these various periods in the early 80s, sort of throughout the 90s, and then also the last, decade, U.S. has been the place to be. We should expect this to flip at some point. We don't know when, but we should expect that to like I say, to kind of the environment start to favor international stocks. Last chart looks at the S&P 500 PE ratio. That's the dark blue. The S&P 500 PE ratio is the light blue, and Treasury yields, the 10-year Treasury yield is the dark blue. There is a definite correlation here, and it's most likely that interest rates are the cause of that correlation. But if we saw, and I kind of marked the PE ratio oscillation here in gold, if we look and this goes back to the late 1800s, we saw PE ratios expand as interest rates were declining. PE ratios went down as interest rates went up. Again, 1920 to 1950, we saw PE ratios increase despite 1929 crash, while interest rates fell. Starting in the 40s, kind of post World War II, we really started to see interest rates spike. And except for this little period of the 1950 into 1960, that's the only real period of this chart where we saw interest rates rising and PE ratios rising. Overall, that was a declining interest rate or declining PE ratios in a rising interest rate environment. And you can just see how much interest rates have collapsed since the late 70s, and PE ratios have skyrocketed. Here's the 2000 tech bubble. This was a spike because of the earnings in the financial crisis got so low, prices spiked, the PE ratio spiked higher, so we can kind of eliminate that. It's, kind of a statistical anomaly. And we're back up here to about 30 on the PE ratio for the S&P 500. So if interest rates are starting to turn higher, if inflation is starting to turn higher, that should cause quite a bit of downward pressure on the markets and at least put a lid on future returns. something we need to watch for. But this is such a deep, long-term relationship. I do not want to bet against it. I don't want to bet that if the interest rates start going up, that PE ratios are not going to be affected. Thank you for listening. Again, this is a Strategic Growth video podcast. You can visit us online at ironbridge360.com. Feel free to reach out directly to me, jim.denholm at ironbridge360.com, or follow us on Twitter at denholm_Jim. I hope everyone has a wonderful Thanksgiving next week and stays happy and healthy and enjoys the holiday, and we will see you next time.